Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome to another episode of Valmika Property Investing Podcast. It's a pleasure to have you again, and I hope you enjoy this week's topic. The title is The Great Rotation, Renters or Buyers Market. So what am I going to discuss today? First, I want to speak about a market analysis that I've done, and it's all got to do with are the winds shifting, and we'll go into that in more detail. Then I would go through the market indicators to watch, and this will give context as to when the market indicates a renter's market and when the market indicates a buyer's market. Then we'll go into some market predictions and opinions. And then, of course, lastly, we'll dive into some strategies for different scenarios relating to potential buyers and investors such as yourself. So let's get straight into it. Okay, let's go through the market analysis. When is it a renter's market and when is it a buyer's market? And why am I comparing these two together? Well, they are the opposite of each other when it comes to cycles. So let's talk about those cycles. And the best way to commence is the most recent market cycle that we have gone through, and that is the hiking market cycle. So what happens when there is rise in interest rates? So when the Reserve Bank of Australia over the last year and a half, they've commenced with a hiking cycle. So we've come off the lows of COVID where interest rates were zero, and we've had quite a few hikes in succession to achieve the cash rate now of around 4.35%. So what that does, when interest rates rise, it does two things. Firstly, those that are on mortgages that don't have fixed rates and those that are coming off fixed rates to floating get a sudden increase in their monthly payments to pay off their mortgages, and it decreases their affordability. So that's one. The second thing it does is when it comes to new mortgage approvals, the affordability rates go down. So there are less mortgages that get written on the back of this. So there's less capital to go around the market. What that does is it decreases the demand for properties, and hence on the back of that, the supply of properties increase because they're not selling. So that has the impact of declining property prices. Now, the opposite of what happens there is because there's less affordability, the people who can't afford to buy anymore, and there becomes quite a few, they move into what we call the renter's market. So they look to rent properties. Now, because the demand on the renting side goes up, there's less properties to rent because there's so many people looking for rental properties. And as a result, the cost per week of rent increases due to this demand. So hiking cycles traditionally create a demand for rentals. And we call that a renter's market, which is good for investors. So investors that are in the market, they're seeing that the rentals every week are going up. And this is because of the hiking cycle. But where are we now? And this is where the debate of the Great Rotation comes in. So we are potentially at the peak of the hiking cycle. But Australia's situation is a unique one because currently, as of the date of this podcast, you're seeing the economy slowing down, but inflation's a little bit sticky. So it has come down from its highs, but now it's bumping along the bottom, and it is, or the bottom, so to speak, for this year, and it started to increase a little bit, and it's getting sticky. So as a result, what this does is it will push out the interest rate cuts that the RBA will enforce later on because they need to see inflation dropping. Now, when yields are positive, real yields, that is. So that's the difference. Let's just take an example in the short end. So the cash rate and the inflation rate. As long as the cash rate is higher than the inflation rate, you've got positive real yields. And positive real yields cause a slowdown in the economy, which should impact inflation as well to come off too. So, because and this is moving on to the renters market, still staying with that, because we've had an increase in immigration into Australia, so you've had 500,000 people, those people generally tend to rent first, and also because the affordability equation impacts them too. More of them that would have wanted to purchase are forced to become renters. So rentals will still be under pressure in my view, especially until interest rate cuts start happening. So what are the indicators to watch when you see there's a relief in pressure when it comes to rental rates? And there are many to look at, but let's focus on the two main ones. The first one is vacancy rates. The second one is days on the market. So vacancy rates are how long a rental property is, and you can see it on a suburb basis, how long they stand empty for before getting a tenant. And you'll see that especially in the capital cities, the vacancy rates are close to zero on residential markets we're talking about now. Second one is days in the market. So how long when a rental comes up for being renewed, how long does it stay on the market for? And that's a good indicator. So if there's less days it stays on the market for, it shows that the demand is high. And in capital cities, the days on market is high. You can also look at days on market indicator for looking for the demand of purchasing properties. So how long they stay on the market for before they get sold. That's a good indicator too. So what are the expert opinions and predictions? So I can give you my viewpoint, and why I think it might be worthwhile for you to consider is because I was an interest rate derivative trader and I traded the market cycles. So I like to think that I have the experience to look in. No one can ever predict it 100%, but I used to predict these for a living. So this is my take on it from my 5 cents worth and from all the economic reports that I have seen. So Australia is in a different situation to the rest of the world. So we've got more like stagflationary worries that are coming forward, which is lower growth, higher inflation. Now, when it comes to choosing the lesser of two evils, inflation around the world from reserve banks is the number one enemy. And then comes growth. So if you can't get inflation under control, and no matter what you do, you will always have a problem with struggling economies and struggling middle class sectors, which is the most biggest important sector of the economy. So I believe that they will keep interest rates higher for longer and higher for longer than the rest of the world. So we've already seen the Bank of Canada cut, we've already seen the ECB cut, but I think the ECB talked themselves into a cut when they probably shouldn't have cut. Now, because they had spoken themselves into a cut, they were forced to cut, but now the rhetoric around it was a very bearish cut. So they are likely to keep the rate at these levels for longer until inflation comes down. So it's very important to keep a gauge on inflation in Australia. I think it will take longer for it to come down. We will probably start our interest rate cutting cycle later than the other developed economies in the world. However, what will that do to property prices? There have been quite a few investors that have been sitting on the sidelines. And you have seen some of those pull the trigger already on purchasing property. So, for example, in Sydney over the last year, even though we've been at the peak of our interest rate hiking cycle, the view is that the next move will likely be down, and therefore those opportunistic investors have jumped into the market, and you have seen a 10% increase in Sydney property prices over the last year. Now, what that tells me is there is a massive shortage of property, because if you can get that kind of growth in an interest rate hiking cycle, it tells me that the supply is very short. Now, when interest rate cuts happen, you will see the floodgates open, in my opinion. So because you've already had a 10% increase in a hiking cycle, when the interest rates allow the mortgages to become, number one, more affordable, and secondly, more of them that will be written because they become more affordable, then the demand for property will just increase, and I think you will see a very healthy spike in property prices around the country. What does this mean for renters? So your rental demand will keep going because property is still unaffordable for many. However, you should see this tapering off, especially when interest rates drop, and if they drop at a significant rate, which is unlikely at this stage, but if you do get a big drop, it becomes more affordable, and this should impact rental increases negatively. So they should taper off and not have the year-on-year growth like we had before in an interest rate cutting cycle. I hope this is insightful and it has given you some ideas around your strategy and what you are going to do going forward. If you've got any topics you would like me to discuss, please send me an email to info@valmikaproperty.com or leave me a comment in the section below. I look forward to speaking with you in the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.